Monetary policy is often portrayed as a sequence of interest rate decisions, a series of point changes and dot plots. But the Federal Reserve's Monetary Policy Report is not a calendar of rate cuts. It is an institutional autopsy of the economy's internal architecture, how inflation, employment, financial conditions, and the balance sheet interact under the governance framework of the U.S. Central Bank. The June 2025 report and the forthcoming February 2026 update are not just updates. They are snapshots of a complex system trying to restore equilibrium after a period of extraordinary upheaval. In June 2025, the Federal Open Market Committee maintained the federal funds rate at 4.25 to 50%. A level it had held since late 2024. That decision was not an accident. It emerged from a balancing act between continued inflation above the long-standing 2% target and a labor market that remains solid, if not uniformly robust. The dual mandate price stability and maximum employment is not symmetrical. It is a governance constraint. When inflation is too high relative to target, the policy priority tilts toward restraining aggregate demand. When labor conditions deteriorate, the priority shifts to support jobs. In mid-2025, inflation had been continuing to moderate, edging closer to the 2% objective, but it remained above it, especially in certain price categories. The report also highlighted another structural theme. Credit conditions and financial activity are still shaped by previously elevated rates. High borrowing costs dampened consumer spending in areas like auto loans and credit cards, even as broader financing remained accessible to most households. This is not only a cyclical effect, it is a monetary governance mechanism, a structural tightening that works through borrowing costs to influence demand and inflation expectations. The labor market is near what the Fed considers maximum employment, but that term is not a fixed target. It is a dynamic estimate of where unemployment no longer generates downward pressure on inflation. This assessment influences how the committee views the neutral rate, the long-run level of the federal funds rate, consistent with stable inflation and full employment. Institutional frameworks like this link real economic outcomes to policy instruments in a way that remains unique to central banking. Another crucial piece of the June 2025 report was on the Fed's balance sheet policy. Over the preceding years, the Federal Reserve significantly reduced its holdings of Treasury and agency mortgage-backed securities, a process often called balance sheet normalization. But the report indicated that this reduction was being slowed to facilitate a smooth transition to ample reserve balances. In simple terms, the central bank was moving away from emergency-era balance sheet sizes without creating uncertainty in financial markets. The institutional logic here is important. The balance sheet is not a residual artifact of crisis policy. It is a governance tool. Large holdings of securities influence liquidity, interest rates across the yield curve, and credit conditions. Changes in that balance sheet reshape the plumbing of the financial system, not just headline interest rates. The Monetary Policy Report also included projections, structured internal forecasts that map expectations for GDP, growth, inflation, and unemployment over the next few years. These projections are not static predictions. They are consensus judgments through a governance lens. They incorporate uncertainty, risk distribution, and institutional judgment about structural relationships between labor markets, inflation pressures, and output. The June 2025 projections suggested modest growth slower than potential and a labor market that might gradually soften, with unemployment edging upward. These projections matter because they signal how the Federal Reserve interprets economic mechanics, not just numbers. They embed assumptions about productivity, demographic trends, global trade influences, and consumer behavior, all under a framework that must be credible to markets, business leaders, and the public. As we approach the February 2026 Monetary Policy Report, the institutional question is not only whether interest rates will be adjusted, it is how the Fed's interpretation of inflation dynamics, labor conditions, and financial stability risks has evolved in response to new data and past policy choices. One of the key debates embedded in the institutional framework is the persistence of inflation. Even though consumer price inflation continued to moderate through early 2025, certain price categories, goods exposed to tariffs or housing services, showed lingering pressures. These categories complicate the inflation signal because they interact with different segments of the economy and labor market in asymmetric ways. Trade policy influences inflation indirectly through import prices and supply chain effects. The Monetary Policy Report noted that it was too early to fully assess these effects, illustrating a hallmark of monetary governance. Policy is constantly provisional, contingent on data that may take months to fully reveal its implications. Institutionally, this provisional stance has consequences for market expectations. Investors and firms do not merely watch interest rates. They watch the Fed's communication strategy. When the report and policymakers emphasize uncertainty in the outlook, they signal a willingness to adjust policy if required. When they emphasize progress toward goals, they signal stability. These signals influence inflation expectations themselves, an important channel through which monetary policy affects the economy. The Federal Reserve's governance framework also contends with distributional effects. Higher rates that slow inflation can also slow investment and hiring, affecting wage growth and employment opportunities unevenly across sectors and demographic groups. The dual mandate forces an unavoidable trade-off, suppressing inflation without inflicting undue harm on employment. How that trade-off is navigated over time defines the institutional character of monetary policy. One institutional trend to watch between the 2025 and 2026 reports is the evolving view on the neutral rate, the real interest rate consistent with full employment and stable inflation over the long run. In the June 2025 report, the committee noted that the longer-run federal funds rate may be lower than historical averages and that the effective lower bound would constrain policy more often than in the past. This recognition reflects structural changes in the economy, demographics, productivity, and global capital flows, and these structural interpretations shape how policy adjusts to new data. Equally important is how the Fed interprets risk distribution around its projections. The June 2025 projections were accompanied by assessments of uncertainty, not precise forecasts, but probability distributions reflecting the range of plausible outcomes. Institutional decision-making under uncertainty is less about certainties and more about managing risk symmetrically, guarding against inflation that refuses to fall and guarding against economic weakness that tight policy could exacerbate. As we look toward the February 2026 report, the institutional narrative will hinge on how these projected paths are adjusting. Are inflation expectations continuing to anchor near 2%? Are employment conditions weakening in a way that signals slack in labor markets? Has financial stability experienced new stresses through credit spreads or asset prices? Each of these questions feeds into the governance calculus the Fed uses to calibrate its stance. Monetary policy is not a mechanical rule applied to a set of variables. It is an interpretive, data-driven governance process that operates through institutional structures, communication strategies, and risk assessment frameworks. The Monetary Policy Report in June 2025 and in February 2026 is a window into that process. It reveals not only where policy stands, but how the Federal Reserve thinks about the economy's internal connections, the distribution of risk, and the institutional tools it wields to steer toward its dual mandate. In the end, the language of monetary policy is not about interest rates and forecasts alone. It is about the architecture of economic stability, the relationships between inflation, employment, financial markets, and expectations. That architecture is what policymakers study, debate, and adjust in every report. And that architecture will define how the economy evolves through the rest of this cycle and beyond. For continued institutional analysis of monetary governance, macroeconomic dynamics, and policy design, subscribe.